What is a total asset optimization and tax minimization plan? I've created thousands of these for clients to help them optimize their assets and minimize taxes. I'm going to go through quickly what we do in a normal plan like this for people. You're going to be blown away on what you can do to optimize your assets, minimize taxes without increasing your outlay one dime. So put on your seatbelt, get ready. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for 5 decades, helping thousands of Americans optimize their assets and minimize taxes. And so when people come to me at retirement, because at retirement planning is something totally different than what maybe they did for their retirement, my first goal is to show them how much better off I could help them be 5, 10, 15, 20 years down the road, clear to age 120 if they live that long, by repositioning their current assets without increasing their outlay one dime. And when they see that they can have double, triple, quadruple the net spendable income, they're like blown away. So get ready. I'm going to show you an example of how I do this. So if I sit down and I'm analyzing a person's financial situation, I often will put this on the screen, this metaphor of a financial Swiss Army knife, because I compare a properly structured max-funded IUL, my favorite financial vehicle, where I keep my serious cash, to a Swiss Army knife because it's got all kinds of uses. And so this is how I'm going to ask the proper questions to help them optimize their assets based upon where they currently have their money. So here we go. You'll see that this is the dream solution for many financial goals. I may say, Jim and Mary, you're here today, and you learned about this in my book, The Laser Fund, and I'll show you how you can learn about this in the book, The Laser Fund. And let's say they came because they realized that they're going to retire in about 12 years. Let's say this is a 55-year-old couple, and they're going to retire at age 67, and they tell me they're going to sock away $2,000 a month for the next 12 years. Now, what I immediately do is I go $2,000 a month times 12 months a year is $24,000 a year. But even though they're not going to retire for 12 years, I only have to times 24,000 by 11 years. This is because in order to grandfather them in the Internal Revenue Code to be able to sock away 24,000 a year for 12 years, 20 years, I only have to calculate the first 11 years to determine the size of the IUL based upon the death benefit. I want the least amount of insurance I can get away with to put in the money that they would like to reposition, okay? So 11 times 24,000 is 264,000. So I write down 264,000 that I need to accommodate in their IUL. Now, next, I'll say, do you own some real estate? Yeah, we have a couple of rental properties. Are you sending extra principal payments against the mortgages on those? Yeah, we send $1,000 a month of our positive cash flow against the mortgages to get out of debt quicker. Now, I usually have had them watch a little video and I go, so do you understand that you could actually accumulate your money compounding tax-free at a rate of return of 8 to 10%, and the cost of the mortgage after your tax deduction is only 4%. That's 100% more. Did you understand how to become your own banker? Yeah. So would you like me to illustrate showing you repositioning $1,000 a month? You're sending extra principal payments. You'll have enough money in your IUL to pay off those mortgages 2.5 years sooner than the way you're doing it. Would you like me to do that? Absolutely. And they saw an example, hypothetical of this, in a little video I gave them, or a little subsection of a book of The Laser Fund, okay? That's called real estate management. And then I asked them, out of any of these properties, are you sick and tired of being a landlord, taking out the trash, fixing toilets, evicting tenants? Yeah, we have a rental. We'd like to sell that next year. We're sick and tired of this property. It's an albatross around our neck. So how much equity do you think you'll have in that? $400,000. Would you like me to make room for that $400,000 in your IUL policy? And you understand how that can be earning a rate of return greater than what you were making on this rental, and you don't have to be a landlord anymore. Yeah. So I make room for that. What about your personal residence? Well, it's worth $1 million. And in 5 years, we plan on selling it and paying cash for 2 retirement homes, $500,000 each. But now we're rethinking our thinking after reading the story in the book. So what would happen if we didn't pay cash for those 2 retirement homes and we financed 2 $500,000 retirement homes, 80% loan to value, and we took out mortgages of $400,000 on each to resurrect tax deduction that we've killed? So we'll end up with $800,000 of that million. Would you like me to show you putting that into your IUL, where that $800,000 could double to $1.6 million, probably easily within 10 years? Tax-free. Yes. Okay. We'll do that. Jim, you're a business owner. Do you keep working capital for your business? Yeah, I keep about $200,000 in a bank, but that's earning nothing, right? How often do you need to grab all $200,000 for buying inventory or meeting payroll? Oh, very rarely. So how much of the $200,000, if you could get that money within 48 to 72 hours, how much of that $200,000 would you like to reposition to increase the safety and the rate of return by putting it into IUL instead of a bank just because it has a drive-up window? Oh, half of that, 100,000. Okay. So I write down 100,000 that I need to make room for in their IUL policy. How much are you setting aside? Your children are all out of the nest, of course. Now you have grandkids. Are you socking away any money for your grandchildren's college education? Matter of fact, we are. We've been socking away $1,000 a month into 529 plans. Do you understand that a 529 plan is not very flexible? If your grandkids get a scholarship and they don't need this money, if they would like that money, you're putting into a 529 plan for a down payment on their first home or to start a business, they have to pay tax. Why would you do that? If you put it into an IUL, you'll earn a higher rate of return than most 529 plans where you have yours after they show me where they have it. And it's totally tax-free no matter how they use it. And if you happen to die, this will blossom to a tax-free death benefit, and it will fulfill itself. You're self-insuring here to where they can have that money if you don't stay around. A 529 plan, if you die, nobody's going to make up the difference for them. So does that make sense? Yes. So I go $1,000 a month times 12 months. That's $12,000 a year for the next 11 years because their grandkids, let's say, are, under age 10. Are you getting this? I'm optimizing assets. I'm not increasing their outlay one dime. I'm just going to reposition it to optimize it to increase the liquidity, safety, and the rate of return and the tax benefits. Okay. Do you keep money on hand for emergencies? Yeah, we try to keep 100,000 on hand. How much of that 100,000, if you could access it within 2 or 3 days, would you like to earn a better rate of return and increase the safety by not having it in a bank or credit union with some drive-up window? Half of that. So 50,000 of that 100,000, would you like me to make room for it in your IUL? Yes. Lump sums. Are you expecting any kind of a lump sum from an automobile accident settlement or sale of a business or a windfall or a lump sum retirement option or maybe life insurance proceeds or an inheritance? Oh, yeah. My wife just got $250,000 in an inheritance. In fact, it's tax-free from life insurance. What would you recommend, Mr. Andrew? And I said, I'd recommend you keep it tax-free. If you do not have an earmark for anything in particular, I'd recommend you keep it liquid safe, earning a rate of return that's tax-free. Should I make room for that $250,000 in the IUL? Yes. Let's see. So far, I calculate that under the TEFRA and DEFRA tax citations, the minimum death benefit that you're going to end up with is going to be maybe $4 or $5 million. Do you have any life insurance right now? Well, yeah, for our estate planning and so forth. We're going to get $5 million of life insurance coming along for the ride here. Yeah, being paid for with a minuscule portion of money that would otherwise go out the window in income tax. You're going to earn 11 and net 10. That 1% is going to be providing $5 million of insurance. Well, yeah, we have a term policy, $1 million term policy. We're putting $250 a month into that. That's not much. I go, well, when you get approved, would you like to reallocate that $250 a month? Yeah. Oh, I noticed here, Mary, you're a school teacher. You're going to have a school teacher pension. And so you will probably meet with human resources in 5 years at age 59 and a half, age 60. You can take this pension. It looks like you were earning about $100,000 a year average the last 5 years. Now, in this state, and this is like most states, you'll get 2% for every year of service. You taught school for 30 years. 2% times 30 is 60% of $100,000. That's $60,000 a year or $5,000 a month in a no survivor benefit pension. But they're going to sit down with you, with your husband, and say, now, $5,000 a month times 12 months a year, $60,000. Your life expectancy is 20 years. That's $1.2 million. That's a pretty big asset. Don't you want to share that with your husband? And they're going to guilt you into saying, well, yes. And then they'll say, well, then I would recommend you lower it from $5,000 a month down to $4,000 a month, take $1,000 a month less. And then if you die, your husband will keep getting $4,000 a month as long as he lives. Don't you want to do that? If you nod your head up and down, that's the most expensive life insurance policy you will ever acquire. And it has no flexibility, because what if your husband dies before you? It will not go to your children. If you die, it's gone. If you get remarried, you can't name a new husband as a beneficiary. That's stupid. I would never buy a life insurance policy like that. And so I say, you know what? You can go ahead and take the $4,000 a month and take the differential and put it into an IUL. And now it doesn't matter who dies first. Your children will not get disinherited. Doesn't that make sense? That's called maximizing your pension. The way the state does it is actually minimizing it. Okay, that's a no-brainer. Okay. What about general tax reduction? This is a strategic rollout. You have $300,000 in your IRAs, 401ks. You don't plan on taking the money out for what? Another 12 years at least. And so it's earning what rate of return? About 6%. Well, it's going to be about 5 years till you're 59 and a half, and you will not incur a 10% penalty. I recommend at that time we make sure you can start accessing that money without a 10% penalty. Get the taxes over and done with sooner than later. Did you read the stories in my book about that? Yeah, we did. So 300,000 at 6% will grow to probably about 368,000. That's easy math. And then let's start to pull out 50 grand a year starting 5 years from now, because 6% on 368 is going to grow to about 500 grand, and it'll take us 10 years to get that 500,000 out and the taxes over and done with. So that's going to show up on the front page of your 1040 tax return. But because of what we already discussed, we are going to take the interest that you're paying on these two $400,000 mortgages, and that will offset the tax. And as you pull out this money out of your IRAs or 401ks, this will show up on the front page of your 1040 tax return, but it will be washed away. You don't have to pay any tax on that, because the interest deductions that we resurrected on these two rental properties, your two, not rental, retirement properties, will offset all the tax. And we'll get $500,000 out of your IRAs or 401ks tax-free. Does that make sense? And in the meantime, the 800 grand will double to $1.6 million. Does that sound like a pretty profitable trade-off? Absolutely. So this is what I do as a tax strategist. Now, what I just did is I went through without increasing this couple's outlay one dime, and then I'm going to show them how much better off they will be. So year 1 through year 12, I have a repositioned savings for their retirement, the extra principal payments they're making on their mortgage, what they were sending in 529 plans for their kids and grandkids' college education, what they were paying in insurance. That's $51,000 a year. And then in the very first year, they got $250,000 from the inheritance, $100,000 out of their business working capital and $50,000 out of their emergency fund. That comes up with $451,000. I make sure that's compliant with the IRS rules for a max funded IUL to avoid what is called a MAC, a modified endowment. Okay. The next year, they're going to sell one of the rentals and have $400,000 on top of the 51. That's another 451. Now, the next 2 years, they just put in 51 and 51. They have room to put in 451. But if you don't use it, you don't lose it. So in the 5th year or even sooner, when they sell their personal residence, they can put in 800 grand in one fell swoop. Because with IUL, if you don't use the room, you don't lose it. If you use a Roth, you only have a little bit of room each year. And if you don't use it, you lose it. You can't make up for years that you didn't have the room. This is incredible. IUL is so flexible. And then from there on, we made room for the pension, the $1,000 a month, $63,000 a year. We didn't have to do this, but they said, no, we want somewhere to put this money. So we add all of this up to year 12. Now, they told me that they wanted about $300,000 a year to retire on after tax. Let's see if we achieved it. The bucket size, the IUL, we call it a GSP, Guideline Single Premium. If you add all that up, that's $2,233,000 we're repositioning. We don't reposition anything that we can't optimize by increasing liquidity, safety, rate of return, and tax benefits. The death benefit, about $5 million. Premiums that they pay in 12 years is $2.3 million. The cash value projection conservatively at age 67 is $3.3 million. At age 69 is $3.8 million. For $300,000 of tax-free income, which is their goal, at age 67, they only need a 9% payout. Most of our clients can get a 10% payout without depleting principal. At age 69, they only need an 8% payout to get that income, and it's totally tax-free. They now have $300,000 a year of tax-free income that doesn't show up anywhere on their 1040 tax return. We do this all the time. So that's what I'm talking about. If you want to have a plan designed to optimize your assets and minimize taxes, remember, optimization means increase the liquidity, safety, rate of return, and tax benefits. I strongly recommend, first of all, study. You can read and learn, you can watch and learn, you can listen and learn. My book, The Laser Fund, has these examples in it, okay? This is a 300-page book. There's 200 pages of charts and graphs and explanations if you're a left brain learner. If you're a right brain learner, you flip it over to this one. This has 62 actual stories in about 100 pages. Now, if you want to use your whole brain, you can read the left brain and right brain side, but it retails on Amazon for $20 up to $60. If you buy it on Amazon, thank you. But I'll gift you a copy free. You simply go to laserfund.com or click on the link below. You contribute a nominal amount toward the shipping and handling. I'll cover the rest of that, and I'll pay for the book. I'll fire out a hard copy to you via priority mail. And when you're in there claiming your free copy, if you'd like to listen and learn or watch and learn, you can invest in those formats. You can register for a free educational webinar that we teach every single week. You can even schedule an appointment to talk to an IUL specialist with no cost or obligation to see how a properly structured IUL can do what I'm talking about here. How much better off you could be.